Two legendary investors and market figures have very different predictions for the short term in terms of the stock market and the economy. And these two individuals are none other than Dr. Michael Burry and David Hunter. Michael Burry is predicting a economic bust and bear market starting right now, if not already getting underway. He's tweeted several very explicitly stated tweets recently that make this very clear that this is his forecast for the near-term future and the longer-term future, just a bear market that begins right now. Mr. David Hunter is, on the other hand, predicting a rally of unprecedented scale for the near-term future, followed by an 80%, roughly 80% bear market. I've had the pleasure of speaking with David just about a month ago. It is very clear that this is still his forecast for this coming year. He expects the market to snap out of this correction that it has been in, and he expects it to then go into this sort of unprecedented melt-up. So today I will take a look at both cases, whether the imminent bear market that Michael Burry is predicting or the reversal and unprecedented melt-up that David Hunter has talked about. So first of all, both of these people are very knowledgeable in their areas. Now, Mr. David Hunter has quite an experience under his belt. He has around 49 years of experience managing money and putting out newsletters out there. He's been fairly correct in his predictions in his career and very correct in the last 2 years in terms of the action that has taken place in the market. Michael Burry is a legendary investor. He's featured in The Big Short by Christian Bale, and he's made some very correct predictions out there in the past, mainly with regards to bear markets and what assets to go short in these markets. So first off, I will take a look at the argument that David Hunter puts out there for an imminent reversal in this correction and a melt-up that would start out of that, a very rapid rally that would start out of that. Basically, what David is pointing out is that everyone right now is so pessimistic, everyone is so bearish, and as a result of that, they have acted on this pessimism, and in response to this, the prices have corrected in the indices, in bonds especially. Yields have gone much higher, bond prices have gone much lower, and so basically just everyone out there is so bearish right now, and they've acted on this bearishness that there really isn't much of a potential for more downside. And this might sound a little counterintuitive, even though the markets have corrected some. They are not down that much. The S&P is down roughly 20%. The Nasdaq is down roughly 30% from their all-time highs last year. But despite this, sentiment is at extreme lows that we actually haven't seen since the Great Financial Crisis. So this is very telling, just in terms of a measurement of the investors who are on either one side of the boat or the other. Sentiment is a very good indicator of where that stands. And just looking back at an article put out by Bloomberg actually just 2 months ago, this article talks about sentiment being at extreme lows, and now 2 months later, sentiment is even lower than back then. So this article put out by Bloomberg, basically a stock gauge that called past market bottoms flashes buy signs, and it was flashing buy signs 2 months ago. So this just shows you how difficult it is to call the bottoms of these kinds of moves. So basically, for the first time since the immediate aftermath of the pandemic bear market, there are fewer bulls than bears in the equity market. So basically, looking back at this chart and then looking down at this bull to bear survey ratio, effectively whenever this ratio reached this level of around a 10th percentile, you had a significant rally thereafter, basically a reversal caused by people effectively going the other way. Once there'd been reached an extreme pessimism in the market, once everybody who had basically could sell had sold, there was effectively a reversal in the trend and everyone began to go back in. The markets rallied, sometimes very significantly from there. Looking back at, for the example, the bottom in March of 2020, the market rallied over 100% there in the case of the Nasdaq. So this is a very accurate signal, at least in terms of the last decade or so. And right now, this bull to bear ratio is even lower than where it is on this chart 2 months ago. We have to actually go back to the 2008 financial crisis to get anywhere close to where this sentiment indicator actually is right now. So basically, the fundamental thesis of David's argument is that um, everyone is just so pessimistic right now. It would be difficult to get much worse than this. And so David has been calling for a bottom for the last several weeks. Obviously, we have not seen that begin to form yet. We could be close to getting there, however. So basically, the fundamental thesis of David's argument is that these trends that have been driving the markets very low in the first 5 months of 2022 could very well reverse in a dramatic manner in which they have predicated the past 5 months. So for example, the dollar has been very strong the last 5 months. It's at 20-year highs. It would be expected for the dollar to begin correcting, if not correcting very dramatically from these levels the dollar index has reached. The dollar is very strong against other currencies right now. It could be expected for the dollar to actually begin correcting from there. Similarly, bonds have rallied. Bond yields have rallied very significantly in the last 5 months. Bond prices have collapsed in the last 5 months. It could be, a very expected kind of move for bond yields to actually head lower from here. And in both of these situations, whether it be the dollar heading lower, whether it be bond yields heading lower, this would take a lot of pressure off of equity prices. It could actually signal that the Fed would need to do less tightening simply because the bond market has actually already tightened. And this is another thing that David Hunter really points out, is a lot of tightening has actually already occurred, even though the Fed has only had to raise rates on the short end of the curve only 2 times. Significant tightening has actually occurred throughout the bond yield curve. So basically all of these factors combined give David the conviction that we will see a very rapid market rally from here. And basically this would simply be fueled by all of the people who are out on the sidelines right now, which is quite a lot of people, quite a lot of capital out there sitting on the sidelines. It would simply be driven by these people getting back into the market. Obviously price action would draw people in as the melt up actually got going. So just a few thoughts of mine on David Hunter's melt up thesis. He has been very accurate in the last 2 years. He has, however, been somewhat delayed in his predictions. So usually he'll say, I see the S&P going to 4,000. That was his immediate target right after the March 2020 lows. He thought that would happen in later 2020. It ended up taking an extra year for that to happen. So my thoughts on David Hunter's forecasting is it's very accurate, but it's usually on the early side. So now without further ado, I'll get into Michael Burry's prediction of a bear market that has already started and that continues to get worse from here. So Michael Burry isn't very active on Twitter. He only puts out a few tweets here and there, but in the last couple of days he has gotten around to tweeting more. Basically, he's made it very clear that he thinks that we are actually in a bear market right now and that it will get significantly worse before it might get better. So Michael Burry tweeted out on the 3rd of May, dead cat bounces are the most epic. 12 of the top 20 one-day rallies in the NASDAQ happened during the 78% drop from the 2000s top in the dot-com bubble. Nine of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. Basically saying that we're kind of in this very volatile stage right now, where we could see dead cat bounces, anywhere from up, 3 to 5% in an index in a day, which is really unheard of. This was obviously right after the Fed's announcement of raising nominal yields on the federal funds rate 50 basis points, and the market surprisingly rallied dramatically in the remainder of the day. So this tweet was in response to that. More recently, Michael Burry tweeted out, "Third time's a charm, 10 years leading to a financial crisis. Yellow is the S&P 500 year 2000, white S&P 500 today, and the green is the Dow in 1929. Got to love human nature. Nothing if not consistent." So basically, Michael Burry is saying that from here we can really expect only a few dead cat bounces along the way during a bear market. And so this is very different from David Hunter's prediction of a epic market rally before a crash. Michael Burry thinks that we are actually already in this bear market, in this significant stock market correction, if not complete meltdown. So Michael Burry, this is nothing new. He's been very bearish on the stock market for the last 6 months or so, when he sold a lot of his positions in, I believe it was the third quarter of 2021 is when he really made this shift to selling out of a lot of his positions. He's been very defensive since then. So it really makes sense that this is now his view of a bear market following from here. So Michael Burry's fundamental points for this bear market, which start right now, is that human nature has been unchanged throughout time. And just looking at for example, the technicals behind the NASDAQ or the S&P 500, it does appear that these charts, these technicals, could be showing that a top was made in roughly November of 2021. And since then, we've been trending down from there. So this overlay that he puts up there very clearly indicates this. Some people on the other side might say that, there's some other fundamental factors that Michael Burry might not be taking into account here. But basically, Michael Burry could be saying that, the Fed really has a difficult decision to make here. Either they fight inflation and send the economy into a recession, or they don't fight inflation. The stock market could recover from where it is right now. There's still very high levels, but there would still be very high levels of inflation, essentially. So Michael Burry could be saying that the Fed has kind of committed to fighting inflation at this point, even with what they've done, which is historically not raising rates to that high of a level. Michael Burry could effectively be summarizing that the Fed, even though they haven't raised rates that dramatically, could in effect be already having a very negative impact on the prices of equities. Obviously, we've seen the price of homes, housing being hurt very dramatically. Also, the NASDAQ, which has corrected the most in the last few months, this has been directly affected by the immense spike in bond yields, simply because all these growth stocks are so dependent on money being very cheap to borrow. So Michael Burry could in effect be saying, now that the cat is really out of the bag with inflation, now that the market is beginning to react to that by raising bond yields so much, effectively that could spell doom for a lot of these high-flying stocks out there, whether it be a Tesla or a Netflix or Google or Teladoc or whatever these ARK Invest holdings are. It already has spelled doom for a lot of ARK's holdings. ARK is down roughly 70% from its all-time highs. But Michael Burry could in effect be saying that, with the market no longer really believing the Fed's transitory inflation talking point, the market has already raised rates very dramatically, and as a result, equity prices could suffer a lot from there. Even right now, with the S&P being down to roughly 4,000, it could head significantly lower simply because of rising bond yields. Bonds, the yields rising on them so significantly, people effectively not wanting to put their money in bonds as much. And so as a result of this, the inverse relationship between the bond price and the bond yield, as people have dumped their bonds in response to very high inflation, the yields on these bonds goes up very dramatically. And unless the Fed does step in and begin purchasing, greater quantities of these bonds again, it really does not bode well for any of these high-flying stocks out there, which at this point, let's be honest, is a lot of the stocks out there in the stock market. It's practically all of the NASDAQ, majority of the S&P 500 are, would fall into the growth and more speculative side if looking from a more historical standpoint. Another one of Michael Burry's talking points is that the stock market is still very, very far from what would be called a fair valuation. The S&P's PE multiple is still very high above the mean where it has typically reverted to. And if anything, during a bear market, the PE multiples actually do fall under the mean, hence why it is called a mean, because there are times when you can be below it. So this in effect would likely be Michael Burry's major talking points: the bond yields heading significantly higher, as well as the impact on PE multiples that this has basically always had does in fact spell doom for major market indices. And so he doesn't look as much at sentiment as someone like David Hunter. Now, just giving my thoughts on all of these points that both of these people bring up, I don't think that either one of them or the other will be completely correct. Obviously, nobody knows what will happen in the market. I do, however, think that they bring very good talking points to the table, and I actually do think that both of them could be correct in different ways. For example, I do think it's reasonable to expect the indices to continue to correct from where they are right now, probably going a little bit lower until we reach maybe a 40% correction in the NASDAQ, maybe more of a 30% correction in the S&P 500. At that point, I would expect that the Federal Reserve would have to begin examining their whole tightening, idea of tightening so aggressively. And if the Fed does begin to reverse from there, all of a sudden you could begin to see a massive interest begin to grow in people's minds of getting back into the stock market in preparation for the Fed doing something like what they did back in 2020. Now, whether they actually did this or not, then we could actually begin to enter into David Hunter's melt-up idea of sentiment just shifting so dramatically at such an unprecedented scale of liquidity moving back into the stock market, moving back into bonds and equities. You could actually begin to see such a rally as what David Hunter has talked about. So these are just my thoughts. I'm obviously not a financial advisor, so don't take any of this as advice, but basically I do think that both of these individuals bring amazing track records to the table. I do think that, neither one or the other will be completely correct, and I actually do think that probably both of them will be correct in different ways. So all of this being said, I'm curious to hear what you guys want to say down in the comment section below. If you like this video, just consider giving it a thumbs up. If you didn't like it, give it a thumbs down. Let me know why down in the comment section below. If you like these kinds of topics that I talk about on this channel, just consider subscribing to the channel if you think I've earned it. And I hope to see you all again at some point.